Let's connect with the one and only Sunil Singhania, founder of Abakkus Asset Management. Sunil, good morning. Thank you for joining us. Must say that you managed to reach your office on a rainy Mumbai morning. You are looking completely dry and the umbrella is missing.
Good morning, Nikunj. I think, having been a Mumbaiite all my life, I think this is a way of life. And in fact, I enjoy monsoons, frankly.
Well, we shall remind you again when the roads in Mumbai will trouble all of us when we go home
Roads I
back.
don't enjoy, whether they are in monsoons or otherwise. So, I urge you and all the other media guys to do something about them.
On it, Sunil, on it. I can promise you that.
Yeah.
Okay, do we need an umbrella now to protect from market volatility?
So I think, volatility is an order of the day always. Obviously, no investors likes correction, and particularly deep corrections the way we have. And particularly Nikunj coming out of a phase where, I think all investors and traders had taken market for granted. The general view was that it will just keep on going up and up. And I think that is not what happens, right? So when you least expect, you have corrections, and corrections, particularly stock specific, have been pretty deep. At the same time, one good thing over the last 10, 12 days is that the market seems to be stabilizing, So I think all the desperate or the forced sellers were able to exit. You don't have a scenario where there are too many lower circuits and, liquidity is not there. I think across board, whatever stocks you needed to sell, you're able to sell. And I think that has allayed anguish to a large extent. And as we speak, I think we are trying to find our feet as far as the markets are concerned. We are consolidating. And I think for the next couple of months, maybe this would be the trend.
Do you think the worst is behind us, Sunil?
See, you can never say, but as far as the prices are concerned, I do think so. The concerns are well known. We all know that inflation is hitting us badly. But at the same time, I think we should not forget the fact that commodities across the board are down 20%. And though oil has still not fallen, our view even on oil continues to be quite benign. And yields in the US, particularly from 3.4, have gone below 3%. So I think there is a possibility that with some luck, you might have inflation which will start to surprise on the positive. And as far as the war is concerned, I think it is starting to become a little bit page or the inside pages rather than the front pages. So let's hope that even on that front, we start to hear less and less bad news.
Sunil, there are three factors which are bothering the market. Number one, where energy prices are headed. Number two, central bankers are right now out there to bring inflation down, committed to bring it down. And third, valuations exactly are not at throwaway levels. So I'll pick up the last part, valuations. Based on brokerage reports and historical benchmarking, whenever markets have bottomed out, the valuations have gone much lower than where they are, which means that the scope for market to correct fundamentally is still very large.
I think statistics is obviously very interesting and very funny. You are right that in previous situations during COVID or even during Lehman, valuations have been at least 30-40% lower than what we are at right now. But those are Six Sigma kind of events. And unless we have that Six Sigma kind of event coming up, I don't think we are going to go to those levels. But Nikunj, we always forget to also mention that we are significantly lower than the peak valuations which we have seen in the recent past, right? We are maybe at least 40-50% lower than the peak valuation we have seen. So I think let us see how the glass is. You're looking at it with half empty, and we are looking at it with half full. So I think given the fact that on the economic front, at least we are pretty decent. Tax collections have been pretty robust. Demand continues to be robust. Monsoons have been very good. So rural economy continues to be pretty decent. Yes, in the past, we have seen valuations fall to even 12, 13 times, and we are maybe around 16 and a half times 1 year forward. But we are not overvalued now. So I would be in the camp which is a little bit more optimistic going forward.
But that's your nature. You're a fund manager. You need to be optimistic at that point in time.
It's not only about a fund manager. I think any investor, any equity investor has to be optimistic. Otherwise, he should not be an investor. An equity investor always has to believe that tomorrow is going to be better than today. The future is going to be better than today. And therefore, unless you have that view, please don't invest in equity markets. Equity markets is all about being optimistic. If you are pessimistic, please buy gold and keep it below your pillow. If you are optimistic, then only come into equity market. So it's not only about being a fund manager. I think it is about being an investor. And Nikunj, last 25 years, only those who have been optimistic and positive have created wealth. The rest are all waiting for the best time to invest.
This point out for our viewers, and Sunil knows this point, but I just want our viewers to understand one simple point. In last 20 years, we've seen it all. Assassination, floods, 9/11, 2008 crisis, COVID. But the Sensex today, which 20 years ago was not at 3,000, was at about 4,000, today is north of 50,000. And that is the power of equity market. It will test you. It will force you to sell stocks. But if you're spending time in the market with good quality stocks, trust me, my friends, wealth will always be created. Sunil, the template of the market has changed, which is same time last year it was all about buying commodity stocks, buy inflationary assets, stay with IT and digital because those businesses were growing. But a lot has changed in the last 3 months. Has your investing approach also changed?
See, before I come to the investing approach, I think this is exactly what we have to keep in mind. Things are very dynamic and things change very, very rapidly. And the same thing will apply to crude, you mentioned earlier, to inflation and so on and so forth. As far as investment is concerned, I think we are in a dynamic world. Gone are the days where we could buy something for 5-10 years and just sleep over it. We are in a world which acts very quickly and very rapidly. And you are right, it was a time of commodity makers. I think we are now heading into a scenario where the time has come for commodity consumers. And to some extent, I think having a diversified portfolio is therefore very, very essential because you will never be able to exactly time when it happens. You see the steel companies, the commodity companies, how quickly the whole, the narrative has changed. And to that extent, I think, yes, we are looking at some sectors, as I mentioned to you, commodity consumers, maybe capital expenditure companies, maybe banks are becoming very interesting because, if the view is that inflation might have peaked out and gradually come off, I think banks should start to do very, very well. So in the portfolio, there has been a minor reject, but anyway, we have been having a very diversified portfolio to that extent. There has not been major reject as of now.
Is it a good idea to run a diversified portfolio because you know which way the tilt is?
See, in the near term, you're right, but to time it exactly is impossible. So, you will obviously be overweight and underweight a few sectors depending on where you believe the next couple of years is going to be. But at the same time, I think you have to have a diversified portfolio. You can't say that I will not invest in this sector or I will not invest in that sector. I think from time to time, every sector becomes, quite interesting. So banks have been one of the worst performers, largely because the maximum brunt of foreign selling has been borne by the financials, apart from the IT sector. But the fundamentals have just kept on improving. And now when you are seeing the banks report their numbers after closure of the quarter in terms of their asset growth and their liabilities and so on and so forth, I think it is giving the markets a lot of confidence that fundamentally, I think financials are heading into a great season. So, from time to time, you have to bear the underperformance, which might be non-fundamental in nature, and, to stick to your perspective as far as stocks and sectors are concerned.
Correct me if I'm wrong, but if I look at your last declared holdings available in a public domain, and if I look at your last declared holdings, let's say in the month of Jan, your top 3 holdings have not changed dramatically. It is still Mastech and it is still HCL Tech. It is still Root Mobile in one fund. It was Root Mobile. Why is that? If you're talking about dynamism, volatility, things are changing so fast, your top three holdings haven't changed in both of your flagship funds.
No, so exactly that's what I mentioned, Nikun, that you have to have a diversified portfolio. At the same time, I think you look at obviously the portfolio, and our view has always been to invest from a 3-4 years perspective. We can't invest from a 10-20 years perspective. We cannot invest from a 3-4 months perspective. But from a 3-4 years perspective, our optimism on the IT services / digital space, our optimism on financials continues to be as strong as ever. And I think that is clearly reflected in our holdings. Also, frankly, we invest as if we are becoming partner in the company. So, unless there is a fundamental shift in the underlying companies, I think more or less you'll find the portfolio same, whether you look at it today, after 6 months, or after even a year.
Walk us through what's happening to the fund activity in terms of inflows. Given that SIP investors are here, I'm also assuming that none of the schemes or the PMS industry per se is not facing any redemption.
So far, when I see the numbers for the mutual funds, I think they have been very reassuring. I think it clearly shows that the retail investors in India have also come out of age. They have matured a lot, and they have realized that even the volatility in the market should not be a cause of scare. In fact, what we see is that on every reaction, the inflows in fact get strengthened. As far as we are concerned, I think we had shut down subscriptions in our mid and small cap PMS towards the end of 2021. And I think that has paid off well. I think now we have opened it again and we are seeing fresh flows coming in. So on a week-to-week basis and a month-to-month basis, I think there has been a decent accretion of flows as far as the mutual fund as well as the PMS/AIF industry is concerned. However, Nikunj, we should not forget that now 1 year returns for quite a few funds would be 0 to negative. And if the trend continues for the next 2-3 months, which at least we don't believe it will, but if it continues, there is a possibility that flows might slow down just a bit. But as of now, we are quite optimistic.
Historical evidence has indicated that every time there has been a recession in US, Indian IT sector has suffered. Your view, which you just mentioned, is that you are bullish on the Indian IT sector and the digital opportunity. Walk us through why.
So there are a lot of ifs. One is, we are saying if there is a recession in the US, I think our view is that the way central banks would not like inflation to go out of hand, they would also not like their economy to go under recession. And that we definitely believe that they will also try and do everything to ensure that, yes, growth might slow down, but the economy doesn't go into recession. Second is on the grassroots level, if you travel overseas, I think there is now a shortage of people which companies are looking at rather than a scenario where demand has collapsed. So as of now, yes, there are pockets where demand has slowed down because obviously if there is inflation, people will have to spend more on their day-to-day expenses and less on the discretionary products. But still the growth scenario continues to be quite robust. As far as Indian IT services companies are concerned, when we speak to companies in India, I think demand is not an issue. There will be definitely some issues in terms of margins because salary levels have gone up. Travel is back, and therefore all the savings which these companies are making on travel will reduce to some extent. But demand scenario continues to be pretty robust. And now with this correction, which we have seen of almost 20-30% across the board, I think companies are now not expensive even on the IT services side. And therefore, our view is that I don't know what is going to happen in the next 2-3 months, but this space is a space where demand is going to be strong. India, this is one sector in India which has global competitiveness. Companies are large, companies are very well run. Cash conversion is almost 100% of profit. Payouts are superb. And therefore, this is a great sector which no investor can ignore, at least in a diversified fund. The digital part of the space is also phenomenal. We are all exposed to it on a day-to-day basis. I think we cannot live even one day without being exposed to the digital side of the economy in whatever we do. And therefore, this is again a space which is going to last for a long time. I think the only problem in the digital space, which we have discussed many times earlier, has been the valuations. So one has to be cognizant of what we are getting into, and not by anything just because the space looks good. Ultimately, we would like to be traditional conservative investors, and we would like to invest in companies where there is profit and where there is profit growth. So, despite our very, very positive view on digital, we would be more stock specific there.
But are some of the new tech companies after the correction on your radar? Do you think there is a rebalancing of valuation and promoter interest?
I don't know about promoter interest. There has been a significant correction as far as valuations are concerned. But even now, for a lot of companies, there is enough room, at least for conservative investors like us. But there are other kinds of investors who maybe understand the space better. And we are seeing some interest reviving. But from our perspective, we would like to err on the side of conservatism.
What is the best way to bet on financials? Insurance, which is beaten down, large banks which are underperforming, or small banks which have a case for comeback because valuations are compelling?
So right now we're sticking to the larger banks, and that is completely from a perspective that in this kind of a scenario where there is a little bit of uncertainty, you're better off in by investing in some of the very large and well-known franchises. But you're right, Nikunj, some of the smaller banks, I think the valuations are now less than book, or in some cases even half-time book. We are analyzing it, but at this point of time, most of our investments are in larger banks. Though we do have exposure to niche NBFCs, because that is also where we see some opportunity opening up. As far as non-fund-based financials are concerned, I think with this current correction, some of them are becoming quite interesting. We have some exposure to the wealth management, broking, as well as insurance side. And we are looking whether, there is possibility of adding one or two names. But that space is becoming interesting after the current, corrections.
So, since the anchoring of your fund is centered around, I won't say mid cap, but semi large cap and mid cap, where are you on this argument of large cap versus mid cap? Because in this correction, small and mid cap stocks have got smashed harder, and Nifty, in a sense, has hardly seen any correction.
I don't think you're exactly right, Nikunj. One is, we do also have a fund which is a multi-cap fund, which invests in a mix of large cap and largest mid caps. The only thing is we would like to be investors rather than allocators. So even in our large cap exposures, which you will have, when you see the portfolio, we would rather be in non-consensus names and invest rather than allocate. As far as the correction is concerned, I think Nifty has fallen maybe slightly lower than the mid and small cap as far as the index is concerned. Yes, some stocks have fallen more, in the broader markets, maybe in 20-30%, but that has been the case even in Nifty. Nifty is not looking as bad because a couple of stocks, particularly ITC, which is up 35%, and till recently even Reliance was up in this downturn, have led to the index not falling as much. But I would say that corrections have been across, whether it is large cap or mid cap or small cap. By nature, the mid and small caps tends to fall more in a declining market, but they more than recover when the market starts to stabilize. As far as our funds are concerned, I think that has exactly been the case. We are more or less in line with the index, maybe 1 or 2% more. But that has always been very clear from our side that if you invest in companies where the growth is faster, the moment the market stabilize and normalize and the uptrend resumes, the companies where there is visibility of higher profit growth will end up moving higher. And I think that is at least our view as far as even the markets are concerned.
Sunil, so 3 years forward, this is 2022, 2025. Imagine you and me meet again, this time in person. It's raining because July it always rains in Mumbai, and we're having chai and pakoda and talking markets. Which end of the market do you think in 3 years has potential to be significantly higher, and which end of the market do you think either will remain low or will not go anywhere?
So, Nikunj, very difficult question, but one thing is very sure, if you look at any block of 3-4 years, you would have ended up ruining the opportunity lost in the previous 3-4 years because we were analyzing too many factors. In a growing economy, and if you don't do very exotic stuff and you don't get carried away by momentum, I think the markets in India have ended up giving you decent mid-teen kind of returns. Some years you have zero returns or even negative returns, but that is more than made up by years like 20 and 21 where you make phenomenal gains. So I think when we speak in 25 and we meet in 25, I'm very sure, we will have a more wealthier country, not wealthier Nikunj or wealthier Sunil Singhania, but a wealthier India. And I think that is the genesis. We are heading into a decent scenario. I think all we need is a little bit of luck. If oil were to correct to $75-80, I think even the near-term headwinds which India has in terms of trade balance, in terms of current account balance, currency, and government finances will be all behind us. You have a scenario now with instead of 1 lakh crore a month, you are almost having 1.5 lakh crores in terms of GST collection. Tax collections have been phenomenal. The digital economy has led to a lot of efficiencies in terms of lower evasion of taxes, higher sort of efficiency in everything you do. I think the country is young still. And in this scenario of the last 4-5 months, India has shown that how self-sufficient it is. So in 2020, we were self-sufficient as far as vaccines is concerned. In 22, when the world is struggling to meet their food requirements, India has shown that it is even self-sufficient as far as food is concerned. I think what better statement to make than what we have seen over the last 2-3 years. So, while clearly, again, just highlighting that I am always an optimistic person, and please take my views with a pinch of salt, I would say that when we meet in 25, we would be as happy as we are today.
Well, cheers to that. And I look forward to that engagement. Really appreciate your time and thank you for joining us.
Thank you for having me. Thank you.